This presentation is brought to you by the SDG Decision Education Center.
Hello, and welcome to 3 Things Every Executive Should Know About Risk Without the Complicated Math, brought to you by SDG Decision Education Center and Texas Executive Education at the University of Texas. I'm Lynn Slattery, Director at Texas Executive Education and manager of a portfolio of open enrollment programs designed for busy professionals. This portfolio includes the Strategic Decision and Risk Management Certificate Program, which brings together the academic research and practical application teaching of UT faculty and 35 years of experience in strategy consulting and decision education of SDG, and serves as the basis for our webinar series. We are proud to be partnering with SDG on this series. Today I'm excited to have Steve Tawney, an expert in decision risk, here with us to explore the 3 things every executive needs to know about how to handle and embrace risk. Steve is a partner and fellow at SDG, a highly experienced professional in decision and risk analysis. He has assisted a wide variety of clients in portfolio management, new business entry strategy, capital investment decisions, and new product planning. He co-authored the 2013 publication Handbook of Decision Analysis. Steve, I'll turn the floor over to you to begin.
Thank you, Lynn. Business executives are sometimes called upon to make decisions that we call big bets, involving significant levels of investment and returns that are quite uncertain. To do a good job on these big bet decisions, the executive will want to base them on the best available information and on solid reasoning and clear thinking. But many executives remain confused about how to deal with the uncertainty and risks inherent in their decisions. In this webinar, we intend to clear up that confusion. So we present 3 things that every executive should know about risk. Number 1, properly taking risk into account in decision making is a straightforward matter. Number 2, using a high hurdle rate is a bad way to adjust for risk. And number 3, most large corporations destroy value by setting their risk appetite too low. Let's start with the first item. Properly taking risk into account in decision making is a straightforward matter. But before discussing how to handle risk, it will be useful to first consider how to handle differences in the timing of cash flows. Consider a hypothetical choice for your company between 2 bonds, long and short. The long bond pays you $200 million 15 years from now, while the short bond pays $50 million just 2 years from now. Let us assume that these payoffs are absolutely guaranteed and that your company has the right to choose one of them for free. Which bond should your companies choose? The timing of cash flows matters because money in the future is worth less than money now. It is widely accepted that you should choose the bond that has the higher present value, which is defined as the amount of money now that is equal in value to the future cash flow, taking into account the time value of money. This time value of money is conveniently expressed as a discount rate, a parameter we use when calculating the present value of a future cash flow. It is quite well known how to calculate the present value of a cash flow given a discount rate. So well known, in fact, that spreadsheet software typically has a built-in function to do it. This chart shows the present values of the 2 bonds on the vertical axis for various values of the discount rate on the horizontal axis. At a discount rate of 0 on the far left, the present value of each bond would equal its payout, $200 million for the long bond and $50 million for the short bond. Then, as we increase the discount rate, moving to the right, the present value of each bond decreases because we're putting less value on future cash flows. Note that as we go from left to right, the present value of the long bond decreases much more rapidly than that of the short bond because its payoff is further out into the future. The chart shows that if the discount rate is less than about 11%, the company should choose the long bond because its present value is higher than that of the short bond. Otherwise, it should choose the short bond. But that raises the question, what is the right discount rate for the company to use? The answer to that question should be supplied by the company itself, preferably by someone in top management, such as the CFO. The chosen discount rate should express the true time value of money to the company based on its weighted average cost of capital. Let's call this the corporate discount rate. As we shall see later, the choice of discount rate should not be based on the degree of risk in the investments under consideration. Now let's turn our attention to the matter at hand, how to handle risk in decision making. Suppose that your company has a choice of investing in one of two ventures. With the first venture, which we call Big Upside, $100 million is invested, and there is a 50% chance of tripling the investment, gaining a net of $200 million, and a 50% chance of losing the investment entirely. With the other venture, called Prudent Risk, $60 million is invested, and there is a 70% chance of doubling the investment, gaining $60 million, and only a 30% chance of losing the investment. Assuming that you are confident that these numbers are correct, in which venture should your company invest? We see that Big Upside has a much higher potential payoff than Prudent Risk, $200 million versus $60 million, but it also carries greater risk, more money at risk, and a much higher chance of losing the investment. One comparison that is often made is to look at the probability weighted average value. For Big Upside, it is 50% of $200 million plus 50% of minus $100 million, or $50 million. For Prudent Risk, it is 70% of $60 million plus 30% of minus $60 million, or $24 million. The probability weighted average is the average value you would get if you could invest in many such ventures. But in this situation, as in most situations in real life, the venture happens only once, not many times. This comparison of probability weighted averages, which we often call expected values, suggests that Big Upside should be chosen. But that might not be the right choice for your company because of its significant risk. Making decisions based on expected values completely ignores the riskiness of ventures. It is akin to ignoring the time value of money when choosing among cash flows that differ in timing by looking only at the undiscounted sum of each cash flow. The fact that it is not always right to make decisions based on expected values can be driven home by considering another hypothetical venture called the Huge Gamble. In this venture, the company invests $1 billion and has a 99.9% chance of losing that investment. But there is a tiny 0.1% chance that the venture succeeds with a huge payout, $2,000 billion, that's $2 trillion. The expected value, the probability weighted average value of the venture, is a big positive number, plus $1 billion. But the venture would be viewed universally as having strongly negative value because of its enormous downside risk. So using expected values to make decisions regarding risky ventures is not a good idea. How should we make these decisions? The proper way to make a decision in the face of risk is to choose the venture that has the higher risk-adjusted value, which is defined as the guaranteed amount of money that is equal in value to the uncertain venture. The adjustment for risk reflects the fact that the value to us of a flow of money is not necessarily proportional to the amount of money. So receiving $100 million may be worth somewhat less than 10 times the value of receiving $10 million. And at the other end, the negative value to us of losing $100 million may be much more than 10 times that of losing $10 million. Just as we have a parameter called the discount rate to use in the calculation of present values, we likewise have a parameter called the quantified risk appetite, abbreviated QRA, to use in the calculation of risk-adjusted value of a venture. The QRA expresses the degree to which the company wants to take on or shun risks. The QRA is expressed in monetary units, and bigger values mean more willingness to take on risk. Just as the discount rate that we use for present value does not, or should not, depend on the specifics of the cash flows we are considering, so too the QRA that we use to find risk-adjusted value should not depend on the specific uncertain venture under consideration. The setting of a company's QRA for decision-making is a task that top management should do with care, and they should review it annually. For large corporations, we have observed that the QRA tends to be in the range of 10% to 25% of the company's market cap, that is the total shareholder value. So values of QRA for large corporations tend to be in the hundreds of millions to billions of dollars. It is important to remember that the QRA is nothing more than a parameter used in the calculation of risk-adjusted value. It is not the most money that the company is willing to put at risk. Once we know the appropriate value of QRA for a company, we can use it to calculate the risk-adjusted value of any uncertain venture via a straightforward calculation that can be easily automated in a spreadsheet. Calculating the risk-adjusted value is just as easy as calculating the net present value. In fact, we can provide you with a free Excel function that calculates the risk-adjusted value for any uncertain venture. Back to the choice between big upside and prudent risk. This chart shows the risk-adjusted values of the two ventures on the vertical axis for different values of QRA on the horizontal axis. As we would expect, as QRA increases moving to the right, the risk-adjusted values of both ventures also increase. That is, as our appetite for risk grows, the value of any risky venture increases. Note that as QRA gets bigger, the risk-adjusted value of the venture with the greater degree of risk, big upside, rises more rapidly than does that of prudent risk. As QRA grows toward infinity, the risk-adjusted value of the venture approaches its probability-weighted average value. From the chart, we conclude that if the company's QRA is more than $350 million, it should choose big upside because it has the higher risk-adjusted value. If it is between $70 million and $350 million, it should choose prudent risk. And if it is below $70 million, it should walk away from both investments. In summary, taking account of risk in decision-making is straightforward. It requires only that the company has assessed its QRA and that each venture is well characterized by a range of possible outcomes with probabilities. And not only is it easy, but also it is the one sound way to achieve consistency in risk-taking. The approach described here is based firmly on the foundation of decision science. So we come to our first polling question. Does your company use QRA to calculate risk-adjusted values? Please answer yes or no. Okay, so we see from the results that it is still a rare company that adjusts for risk using QRA. It's not a big surprise, which shows that there's a lot of potential value to be gained in the business world in using a proper way for adjusting for risk. Let's go on to item number 2. Using a high hurdle rate is a bad way to adjust for risk. In a typical venture, we invest some money now and get an uncertain payoff in the future. In other words, a typical venture has both risk and time components. A common way to think about valuing such a venture goes something like this. To account for the timing of the payoff, we need to discount it using our normal discount rate. But because the payoff is uncertain, we need to discount it further by adding an appropriate amount to the discount rate. This higher so-called risk-adjusted discount rate is often called a hurdle rate because the venture, if successful, must have a rate of return that exceeds that hurdle rate to be attractive. Let's see how this works with a simple example. Suppose that your company has the opportunity to invest $100 million in a venture called the 4-year bet. There is a 50% chance that the venture will pay $300 million 4 years from now, and a 50% chance it will pay nothing. Should your company take this investment? If successful, this venture's rate of return is about 32%. That means that the net present value of the cash flows, if successful, is 0 when the discount rate is 32%. Is this return enough to compensate for the risk? Well, let's suppose that for this level of risk, your company has set the appropriate hurdle rate at 40%. Accordingly, you should not make the investment because its rate of return does not exceed the hurdle rate. Consider now a similar venture called the 2-year bet, which is the same as the 4-year bet, except that the payoff is 2 years from now instead of 4. And the payoff amount is lower, $262 million instead of $300 million, to compensate for the fact that the payoff is 2 years sooner. The present values of the two payoffs are the same at an assumed discount rate of 7%. So the 2-year bet has exactly the same level of risk as the 4-year bet. If successful, the 2-year bet has a rate of return of 62%, higher than your 40% hurdle rate, so you would accept this venture. But it has the same level of risk as the 4-year bet, which you reject. To be consistent in your decision-making between the two ventures, you would need to set a much higher hurdle rate for the 2-year bet than for the 4-year bet. This illustrates the fundamental problem of using hurdle rates to adjust for risk. In doing so, we are asking the discount rate to do two jobs, one for which it is well suited and one for which it is not. Raising the hurdle rate to account for risk assumes that risk increases in proportion to the timing of the payoff. In general, this is not true. In fact, we can imagine a third venture, the 0-year bet, which is just like the 2-year bet, except that the payoff is nearly immediate. In that case, there is no hurdle rate high enough to make the venture look too risky to take. And there are some risky ventures, like selling insurance, in which the cash flows are flipped around. A sure positive cash flow now and an uncertain negative cash flow in the future. For these ventures, using the hurdle rate would actually lead us to choose the bigger risks. What is the proper way to evaluate a venture with both time and risk components? Well, it's simple. First, use your standard corporate discount rate to find the present value of each possible outcome of the venture. Then use your company's QRA to calculate the risk-adjusted value of the venture based on these present values. For the 4-year bet, it looks like this. At a risk-free discount rate of, say, 7%, the present value of the venture is $129 million if successful and minus $100 million if not. This chart shows the risk-adjusted value of a 50-50 chance at these present values for various values of QRA. So you should invest in the 4-year bet only if your company's QRA is higher than $450 million. The 2-year bet has exactly the same risk-adjusted value as the 4-year bet for any value of QRA, confirming that they have the same level of risk. Notice that doing it the proper way is easier than using hurdle rates. We do not have to figure out what the appropriate hurdle rate is for each venture. We need only the two parameters that we already know, the company's normal discount rate and its QRA. So we come to our second point question. Does your company use high hurdle rates when evaluating risky investments? Please answer yes or no. Okay, so we see it's about 40-60. 40% say yes, they do, and 60% say no. 40% is higher than we would like to see. It's we think not a good practice. So again, there's opportunity for value creation out there in the business world. Let's go on to the third item. Most large corporations destroy value by setting their risk appetite too low. Within multi-divisional corporations, it may seem sensible that each division should take on only those risks that are appropriate for its size. But this is actually a value-destroying practice. Let us suppose that the head of a division is considering the choice we looked at before, whether to invest in big upside or prudent risk. And suppose that she makes decisions that are consistent with a QRA of $200 million, which seems appropriate for the size of her division. We can see that she would choose prudent risk because it has a higher risk-adjusted value, $16 million versus negative $2 million. But her division belongs to a corporation that is, let us say, 5 times larger than her division. From the perspective of corporate headquarters, where the QRA is $1 billion, the ventures have much different risk-adjusted values, $22 million for prudent risk and $39 million for big upside. Corporate headquarters thinks that the divisional head is throwing away $17 million in value by choosing prudent risk. This undesirable situation is all too common within large corporations. Decision makers at lower levels of the organization make choices that reflect far too little risk appetite given the corporation's financial strength. As a result, the corporation forgoes valuable opportunities that it should take. The remedy is for corporate headquarters to establish a clear policy that all big bet decisions must be made consistent with the corporation's QRA, just as it should insist that all present value calculations use the same corporate discount rate. And divisional decision makers should be supported by a corporate culture that rewards appropriate risk-taking and does not punish bad outcomes that are beyond their control. Why does this matter? Well, it matters because corporations that consistently use an appropriately large QRA in decision-making have a competitive advantage over those that do not. One of the main advantages of large size is the ability to pool risks and thereby take on value-creating ventures that smaller players reject as too risky. A corporation that gives up that advantage by playing it too safe will very likely be outperformed by one that appropriately uses its greater appetite for risk. Pooling of risks works. A portfolio of 5 independent ventures like Big Upside, for example, has an expected value that is more than twice as big as that of 5 independent ventures like Prudent Risk, and nearly the same probability of losing money. Always remember that when you discount for risk, you are giving up value in exchange for safety. The more you opt for safety, the more value you lose. So you want to make sure that you find the right balance between the two. So here's our third point question. Does your company use one common QRA for all its decisions? Please answer yes or no. So we see the results that only a small minority of corporations use a common risk appetite across its decisions. Again, a lot of opportunity for value creation in our corporate cultures. So to recap, we have discussed 3 things that every executive should know about risk. Number 1, it's really easy to properly take risk into account in decision making. Number 2, don't do it by setting a high hurdle rate. And number 3, make sure that all decisions within the corporation use the same appropriately high risk appetite. And now I'll turn it back over to Lynn.
Thank you, Steve, for bringing us your expert insights on the things executives need to know to handle and embrace risk. And also thank you for skipping that complicated math. Let's go to our first question. Steve, someone is asking, how should one adjust for risk in managing a portfolio?
Oh, good question, Lynn. To calculate the risk-adjusted value of a portfolio, one should, of course, start by quantifying the uncertainty in value of each asset in the portfolio. But then one should also take into account the degree to which the asset values are correlated with each other. Having assets that are positively correlated with each other actually increases the total risk in a portfolio and thereby decreases its risk-adjusted value. And on the other side, having assets that are negatively correlated with each other decreases the risk in a portfolio, which then increases the portfolio's risk-adjusted value.
Wonderful. Yeah. So taking all those correlations into consideration is a big job, but we'll leave that more for next class and move on to a second question. What are the best practices in strategic risk management for a company?
Yes. Risk management for a company should begin, of course, by identifying and quantifying the various sources of risk that it faces and showing how each of these risks impacts the total value of the company. One should, of course, focus most time and attention on those risks that have the biggest impact on total value. So making use of tornado diagrams makes a lot of sense. The goal of this part of the risk management process is to calculate the total risk-adjusted value of the company in the status quo. Then one should explore different ways to increase the company's risk-adjusted value by avoiding, controlling, and mitigating those risks. As we make clear in the course you mentioned, the value-driven enterprise risk management, we say that one should manage both upside opportunities as well as managing the downside risks.
Sure. Okay, I'm gonna not comment and squeeze one more question in before our time is up. How can one measure risk when the uncertainty of failure outcomes is poorly understood?
Yeah, it's a tough one. Even when one has precious little information about future events that might have a big impact on the success or failure of a venture, one should do as good a job as possible in quantifying the uncertainty in terms of probabilities based on the best available expert judgments. One should definitely not simply ignore such sources of uncertainty and risk because they're hard to think about. Indeed, the quantified ranges of uncertainty should be appropriately wide given the lack of solid information, and one should recognize that the value of acquiring new information in these cases is likely to be quite high.
Wonderful. Thank you, Steve. I also want to say thank you to our participants for spending your time and energy with us. That is all the time we have for today. We will answer additional questions offline that we were not able to get to, and we look forward to connecting with you again very soon. Have a wonderful day.